Two people can earn the exact same paycheck. One walks out approved for a $500,000 house. The other walks out with a polite no. And I am here to tell you that gap has almost nothing to do with luck. It comes down to one formula. Every bank runs the same math on every buyer. And once you can see that math the way the lender sees it, you stop guessing and you start planning. So let us walk through exactly how much income you need to qualify for a $500,000 home this year, line by line. Fast disclaimer before we go further. I am not a financial advisor. I am an animated host who happens to look like the boss's daughter, mostly because the boss owns the building and somebody had to run the show. So take this as education, not advice, and bring the real paperwork to a licensed human. Now, the math. Step one is figuring out what a $500,000 home actually costs you every month, not the sticker price, the payment. Start with principal and interest, which is the loan itself. On this price, that runs about $2,900 a month. That assumes a 3.5% down payment and a 6% interest rate. On top of that, you add home insurance and property taxes, and both of those are baked into your monthly payment. Here is the part most people miss. Those two numbers are variables. They swing hard depending on which state you live in and even which part of the state. Buy down in the Miami area, and your home insurance climbs well above average. Buy up in New Jersey, and your property taxes can do the same. Same house price, very different monthly payment. Then there is mortgage insurance. You carry that when you put down less than 20%, and on an FHA loan, it stays for the life of the loan. Budget around $220 a month for it. Add everything up, and your total monthly payment lands near $3,800. Still with me? Good. That payment is only half the equation. The banks care just as much about everything else you already owe. Let us add it up. Step two is totaling your monthly debt. That means your car payment, your credit cards, child support or alimony, student loans, and any personal loans. The bank also folds in your future mortgage payment, the one we just calculated. One key detail, they look at the monthly payment on each debt, not the full balance you owe. A $30,000 car loan does not scare them. The $400 monthly payment is what counts. Now, what does not count? They do not include your rent, your gas, your cell phone, daycare, or your insurance like health and auto. Those matter to your real life, but they do not show up in this calculation. Let us put real numbers on it. Say your monthly debts add up to about $1,000. Add the future mortgage payment, roughly $3,800, and your total monthly debt lands near $4,800. Here is the formula every bank runs. They allow up to 50% of your gross monthly income to go toward your total monthly debt. So to find the income you need, you take that total monthly debt and you multiply it by 2. Run our example. $4,800 in total monthly debt times 2 gives you about $9,600. That is the gross monthly income you would need to qualify for this house. If this formula just made the whole process click for you, tap that like button. It tells the algorithm to show this to the next person who needs it. Back to work. Let us see how different debt levels move the income you need, all for the same $500,000 house. If you carry no monthly debt at all, you only need about $7,600 of monthly income to qualify. Remember, this is gross income, pre-tax, before anything is taken out. If you carry $1,500 of monthly debt, you need around $10,000 of monthly income. At $2,000 of debt, you need about $11,000. At $2,500 of debt, you are looking at roughly $12,000. The pattern is simple, and it is unforgiving. The more debt you carry, the more income you have to prove to qualify for the same house. Now, here is why two people with the same income and the same debt can get approved for two completely different amounts. First, the down payment. The more you put down, the more you can get approved for because you are borrowing less. Second, taxes and insurance, which we already said swing by state. A high tax, high insurance state pushes your monthly payment up, so you get approved for less. Third, the loan type itself. FHA and VA loans are the most lenient on debt, so they tend to approve you for more. Conventional sits in the middle. USDA is the strictest, so you get approved for the least going that route. One thing you have to understand, the bank approves you on your gross income, the amount before taxes and deductions, not your take-home pay. So a pre-approval is not a promise that the payment is comfortable. It only means the bank believes it will get paid back. The bank is not thinking about your retirement savings or your lifestyle. That part is on you. So before you ever get pre-approved, decide your own comfort number. Know the monthly payment you actually want to live with, and have the lender work the pre-approval backward from there. Here is a budgeting guardrail a lot of advisors use, the 30% rule. You keep your housing payment to no more than 30% of your take-home pay each month. When you run your own numbers, hold them against that rule to check whether your payment is in a healthy zone. Let us look at the actual down payment on a $500,000 house across loan types. On an FHA loan, 3.5% down comes out to $17,500. On a USDA loan, there is no down payment required, so that is zero down. On a conventional loan, if you are a first-time buyer, the minimum is 3%, which is $15,000. And on a VA loan with full entitlement, there is no down payment required either. There are hundreds of grant and down payment assistance programs built for first-time buyers, all designed to help cover that required down payment. They come in two main flavors: forgivable grants, which you never have to pay back, and deferred loans, where the money gets repaid when you sell or refinance, or added as a small payment on top of your mortgage. So know exactly which type you are signing up for and read every stipulation. And work with an experienced mortgage broker who has access to these programs, because the right one can change your entire buying picture. Closing costs are separate from your down payment, and a lot goes into them. Lender fees, title fees, government and state stamp taxes, setting up your escrow account, which prepays a chunk of your property taxes and homeowner's insurance, and HOA fees if you are buying into one. Altogether, that usually runs 2 to 4% of the purchase price, and it varies by state and even by county. Here is a tip that can save you thousands. You can ask the seller to cover your closing costs. You negotiate that upfront through your realtor. Let me give you a real example with Tobin. He found a house, used a grant to cover his down payment, then negotiated the seller into covering all of his closing costs. He walked up to the closing table and brought $0 out of pocket. Your credit score touches three big things. First, your interest rate. Higher score, better rate. Second, the loan type you qualify for. A lower score usually pushes you toward FHA. Third, the approval itself, because a higher score sails through underwriting far easier than a low one. The practical minimum is around 660. You will see places advertise 580 and up, but at that level, you get hammered on the rate and the fees, and you often need a much bigger down payment. Long term, you are better off lifting your score above 620. If you are at 580 or below, give yourself 6 months to a year to build it up. Get to 660 plus, and most of your options open up, including more grant and assistance programs. And if you want the best interest rate available, aim for 760 and above. Clear any collections and keep your credit card utilization low, under 20%. If you are getting pre-approved down the road, here is how to set yourself up. First, lower your monthly debt as much as you can and avoid taking on any new payments because new debt drags your approval down. If one payment is huge, attack that one first, since it moves the needle far more than the small ones. Second, work on your credit. Get it to at least 620. Aim for 660 for the most options, and 760 for the best rate. Third, save aggressively. You can tap a 401k for a down payment, and grants can help. But do not walk in depending on a first-time buyer program because their rules are strict. Always have a backup plan for that down payment. Here is the timeline. If you are about 6 months out from buying, that is when you talk to a lender or broker, so you have time to build a plan and fix anything that needs fixing. When you are about 3 months out, that is when you actually start the pre-approval process. If you want to run these exact numbers for your own situation, check out the ebooks and the financial calculators over at Jetset Wealthstyle. Links are right below. They do the multiplying, so you do not have to argue with your own math at midnight. And subscribe while you are here, so the version of you that owns the house can look back and thank the version of you that finally did the homework.